Hello, everyone. My name is Yoki, and I'm on the Vancouver Startup Week team. And I would just like to take this moment to acknowledge that we are grateful to be virtually gathered on Indigenous land, regardless of where you are joining us from. And I'm grateful to be on the traditional, ancestral, and unceded territories of the Musqueam, Tsleil-Waututh, and Squamish peoples, and privileged to live, work, and play on these lands. First, I'd like to thank you all for joining us at VSW 2021, and welcome to After Bootstrapping, Best Practices in Raising Capital and Legal Considerations, hosted by Manning Elliott and Harper Gray. This session is part of the VSW Founder Track and is proudly supported by Sage Accounting. Sage knows that you didn't start your business to become an accountant, and sorry to all the accountants out there, but Sage Accounting keeps your business organized and running smoothly. You can track your cash flow, send out invoices, and get paid quickly. Visit the Sage Accounting booth to access free guides and templates for starting your business finances the right way. Plus, get an exclusive VSW discount if you're ready to switch from Excel. I also want to thank Manning Elliott and Harper Gray for being our event partner and also a sponsor. And VSW cannot happen without the continuous support from our community sponsors. During the session, if any of you have questions for our speakers, please post them in the Q&A and Whova. You can also upvote questions there. And I'll now pass the mic over to, is it William, who will start us off?
Thank you, Yoki, and welcome everyone to VSW 2021. Just to start things off as a brief introduction, I'm a principal of valuations at Manning Elliott. So we're a full service accounting, tax, and valuation firm in Vancouver, BC, Abbotsford, Surrey, and Burnaby. And my colleague Joseph is here as well. Might be having some audio difficulties, so Prentice, if you don't mind.
Sure, I'll happy to step in while Joe's getting dialed up and connected. Good afternoon, everyone. My name is Prentice. I'm a partner at Harper Gray LLP. Harper Gray is a local regional law firm here in Vancouver. We're located in the downtown core. We have about 90 lawyers covering litigation and really almost all areas of corporate business law. I'm a corporate finance lawyer, and I spend a lot of time in the tech startup space, and happy to be a part of Vancouver Startup Week again. So thanks to Will and Joe and the Manning Elliott folks for linking up with us to take part in this together. And with that, I think Joe might still be connecting. Yeah, he's not connecting quite yet. So I'll just take the opportunity here to introduce my colleague, Ryan Bensick, who is going to act as our moderator here. Ryan's one of our bright, shining young stars here at Harper Gray, and he loves to be online as much as possible. So we asked Ryan to keep us on track and on time today. And with that, Ryan, I'll turn it over to you to get us going.
All right, sounds good. Joe, maybe we might have to get you to drop out and come back in again, but we'll keep powering forward in the meantime here. Oh, there we go. Let's see if he comes through. Folks, in the meantime, if everyone has their Whova apps, we put out a couple polls along the way just to get a temperature of the audience. We've sort of asked where folks might be at in terms of financing, or if you're seeking financing, where you might be along the continuum of when you might need some money, or what brings you to the panel. So, you know, as you're waiting along the way, if you have those Whova apps open, if you can let us know along the way, that gives us a bit of a better idea for how to dial in the conversation. With that said, why don't we tee us off with the first question. So if anyone has questions along the way, jump in, let us know. Otherwise, we've got a roadmap to walk us through what financing might look like and some of the things to think about along the way. And with that, let's kick off the first question for the panel of what are the various financing rounds and what do we have to do to prepare for them?
So I could start with that one. So usually, as the title might suggest, the first step for most tech companies is really the bootstrapping part. That's really the personal, friends, and family kind of investments into your idea. In essence, for that, it's really kind of still kind of cementing your idea first. But as you progress through the development of this idea into an actual business, that's when you start thinking of additional rounds of financing, mostly external, because then you're starting on thinking about engaging or hiring a management team to help you run the business efficiently, hiring external staff, developers, app developers, etc. So that's when we start thinking about seed stage and of course the series ABC. And each series kind of progresses into more complexity in terms of what the business owner plans to do with that idea. The seed kind of is self-explanatory in and of itself, whereby it's really starting to go from an idea into an actual prototype. And then the series ABC is really getting more and more expansion oriented as well. And Prentice, if you have anything to add to that from your legal background, that'd be great.
Yeah, sure, happy to do so. It's Will's hit the nail on the head here, just in terms of the various rounds and so many. I think there's a common trend, whether that's I don't think it's exclusive to the tech startup space, but just generally starting companies, is that many entrepreneurs sort of are going, sort of skipping steps or thinking that they can skip to raising millions of dollars right from the outset. Their idea is something that's going to, of course, take off, and we hope will be successful. But I think that there's a realistic component of learning to walk before you run. And as painful as it might be to bootstrap, you got to do it. And then you've got to raise a little more money, and that's that friends and family round. And you sort of go through these various phases, and it's almost a rite of passage. It's just more common to go through these various stages, and certainly more rare to leapfrog and start raising millions of dollars right from the get-go.
Thank you, Prentice. And just to add to that, as in terms of how each step kind of progresses forward, you could think of bootstrapping, you're selling yourself to, say, your friends and families to buy into your idea. Do they really have a concrete idea of what you want to do? Probably not, but they rest their faith in you personally. However, as you go through, say, even starting with the seed round, based on my previous experiences with these, starting with seed and more so in series A, B, and C, it becomes less on, of course, you as the business owner, the investor needs to believe in you, but more so as well as to the numbers needing to start speaking a story, if you will, as well as to what exactly the business owner envisions in that business. So it kind of flows towards the numbers part, where what's the profitability, or what's the daily active users? Essentially, what are the metrics and what are the KPIs or key performance indicators of that business? And then it's really combining all those different pieces together to make a coherent story at the end to present to the investor, so that they have the faith and confidence to ultimately give you millions of dollars to really expand that business into the unicorns that we know of today.
One thing that's probably helpful for the audience, just to pepper some questions here, what kind of prep goes into we've done the friends and family, we've done the bootstrapping, we've maybe raised 10, 20, 30, 40, 50,000 from friends and family that are close to us, and we need to raise some real money with a seed round. What kind of prep goes into that? What does that look like?
Yeah, I think it's what it looks like is a longer time frame than you would like, than the entrepreneur would like. Talking to more people than you've ever realized you could talk to. Kicking enough tires that your toes, if not broken, are beaten up and maybe black and blue a little bit. But it's a lot of work, and it's that first, as well described, that the early investors, they're investing in you. And when you go to that seed round, it's not just you, it's your idea and selling your idea. And the founder wearing many hats as principal shareholder, likely CEO, that person is the biggest champion of the idea, of the concept, of the widget that's going to be sold, and they have to tell the story. And you don't have money to hire a PR person or a marketing person. It's you. And you're paying yourself nothing because you're bootstrapping already and you don't have any money, so you got to find it. So it really is that person. And so you know, many people are quite successful at it, but not without a whole lot of blood, sweat, and tears. You know, they do spend a lot of time getting to know people, having lots of coffees, probably too many coffees, but it's all necessary in the process. So, you know, that's really where it comes from. And part of that is, you know, the network and the introductions to various folks, and you never know where things are going to lead, and you never know where that next coffee date might lead, or information session. So it's really, you know, go back to, it's a lot more work than you think, and you just don't know where it's going to lead you, or to whom, but it's necessary. And those that do it quickly, you know, I think that so many times they're just lucky.
I agree with Prentice there. So yeah, the connection and the networking definitely is a must for, especially around the seed rounds and any subsequent rounds as well. And then of course, typically, I mean, the investors are pretty transparent as to what exactly they're looking for in terms of getting a better understanding of the business itself. So usually they'll probably ask for, what are the preliminary revenue figures? How did the business do? Around the seed round, this is when you start getting 1 to maybe 10 customers, maybe. And that's when they're looking at what's the revenue per customer, what's the churn rate or the customer attrition rate, have any dropped off, what's the add-on rates, and then granted, overall, what's your expenses looking like? And granted, for the most part, the most recent, say, 12-month figures aren't representative of what the business will be looking like going forward. So granted, what the investor is looking for is, this is what the business has done for the last 12 months or the last year. And it's on the business owner now to kind of, again, tell the story of, this is what I envision the business to look like in the next 3 years, 5 years. 10 years might be a bit too aggressive, but typically in terms of a forecast, the next 3 to 5 years is pretty key as to what the investor, whether they'll have the faith to invest in this company and in your business idea, really. So it's really being able to provide a preliminary forecast as well.
Yeah, I think that's right. You know, the other thing about raising some of the seed capital and finding the right investors, and I think that is another component. It's just not about finding someone that will write a check. It's about finding, you know, think about them as a future business partner. Not only are they going to, you know, believe in you and write a check and all that sort of stuff, but you want someone that is, you know, to be blunt, you know, someone that's going to roll up their sleeves and help you along the way. You know, not only just do they write a check, but are they strategic in the context of what else are they going to be able to help you do? And that could be, you know, more introductions, but it could be industry experience or finance experience or some other component that is an add-on that builds up that that founder's skill set. You know, albeit in the context of a company, but it's more than just writing a check. It's looking for some more folks.
Yeah, I agree.
Maybe we quickly let Joseph introduce himself and we can dive right back into that discussion, because I've got some questions about how we figure out who to get us to help along the way.
Oh, I think I got my audio problem solved here. Sorry for the delay. Yeah, thumbs up. Yeah, so I'm a senior manager here at Manning Elliott. I just moved over from a large national firm. My practice area is primarily with public company audit. I've worked a lot with private companies that are looking to do an RTO, raise capital, as we talked about earlier about seed financing and kind of navigating those steps, and going through the whole IPO process or an RTO or what have you. So if you have questions regarding either regulatory or just the accounting implications, I think I can hopefully answer your questions.
And just a quick temperature from the audience. We've got, looking through the poll answers so far, it sounds like there's a lot of folks that are looking to gather more information about whether they need to raise money externally, what that looks like, what advisors might look like. And in terms of the timing, there's some folks thinking about raising money in the next 3 months to the, well, 3 months, 6 months, 9 months. It seems like it's roughly an even split. Whether that's feasible or maybe a bit quick, we'll let the experts here talk about that maybe.
Yeah, maybe I'll start off because it's when, when's the right time to go for and seek investment. I mean, if in a perfect world, we have our own bottomless pockets and we never have to go seek investment because we fund ourselves, we never dilute ourselves, and we get to call all the shots because we don't have to report to anybody. But of course, that's wishful thinking. So at a certain point, we don't have bottomless pockets, and we've racked up the visa, and we've got to look for alternative forms of investing. So, it really comes a time where, for whatever reason, being the account is getting down to zero, you've got to raise money, and you don't have it on your own, so you have to go out and look for it. And I think one of the, what is that time horizon? As a founder CEO, you're looking for money all the time. I think that's the general rule, is you always have to be looking for your next round. And you don't know when it's going to take place. And it's also you're in a much stronger position as a company to look for money when you don't need it. That's when you have more bargaining power. When you're too little too late and you have no money and you're trying to make payroll next Friday, the investors can really hold your feet to the fire and make you pay, whether that's an interest rate or whatever it is, dearly, just because of the position you're in. So, start early, and given the amount and what you're trying to do, all those timeframes it just depends on the circumstances. William, what do you think?
Yeah, just to add to you, Prentice's comment, yes, I agree. It's, as a business owner, you'll always need money, and in general, not necessarily specific to the tech space, is that there are always going to be unforeseen circumstances which requires a chunk of capital here and there. Maybe one of your equipment that's necessary, extremely necessary for your operation, suddenly just breaks down and you have to repair it or find a replacement. Those are unforeseen, but those take capital. So it's always good to have a balance in your checking account as opposed to seeking funds when you need it. It applies to, say, even personal. So in a business, it's no different. So as early as possible would always be ideal.
When you're starting off, typically what I've seen is, you're doing your financing through friends and family. Prentice, do you have any thoughts as to share structuring on that? I've seen various, Class A, Class B, or pref shares that are being issued. So, considerations on share structure with the expectation that eventually, what's the share dilution going to be, and just kind of what you've seen on the private side before going public?
Yeah, so it really depends on the path that's been taken leading up to the go public event, and there can be several classes of shares or one. I think that probably people try to overthink the situation in advance too early, and so I'm a simple guy and I like to keep it simple. So when I'm incorporating companies in anticipation of investment, we just incorporate with one class of shares, a common voting share, and then we sort of structure around that. And we wouldn't volunteer a preferred share until an investor demanded it. We wouldn't volunteer a board seat until the investor demanded it. We wouldn't, just wouldn't do these things, because as much as it might seem like an eventuality or, something easily to give, as soon as you bring another director on, it brings a whole new dynamic. A pref share has, I guess, a priority ranking to your common share. And so, until we get there, and until we actually are able to negotiate a transaction that includes whatever the special rights and restrictions are attached to those pref shares, I just don't go there, right? I just try to keep it simple. And when the time comes, then we navigate through. Another classic ask is non-voting shares, and how do we use those? Can we use them? And I think that really what we're trying to do actually gets mixed up in doing so. You create another class of shares, even though they're non-voting, they have fundamental rights, and they do actually get a vote, and not just a vote, but a veto if you're not careful. So it's really important to not overthink it early. Keep it simple as long as you can. And really when only, boxed in the corner do you sort of go, okay, I need another class of shares now.
Maybe this is sounding crazy, guys, but what I'm hearing is we should maybe just keep common shares until we shouldn't. Does that sound, is that common advice?
That's what I would say. It's a cost of capital to create this new class of shares, and it has sorts of implications.
Yeah, and Prentice is bang on there. You don't need to add more complication until you absolutely have to. You've got bargaining power and leverage until you start giving up stuff like board seats and pref shares or what have you, right? So keep it simple, stupid. The whole KISS philosophy until you actually need to go that route. But that's a bargaining chip that you have, So do your class A commons and then go from there. And to Prentice's point, like when you can go down to like a non-voting common share, like a class B or something like that. But you get to a point where you need a special resolution of all the shareholders, and they're going to have a say. So just try to keep it as simple as you can, as long as you can.
Yeah, thanks, Joe. There's two other things about that too. One is more share classes means you're paying me more, and no one wants to pay me more. Like they want to set up their companies and do it on a really, not expedited, but just, a cheap, good value for bang for buck, if you will. So creating all these other classes of shares creates complexity that costs you more when it's too early to be paying those bills. The other thing too is that with the non-voting shares, typically those folks that we want to have non-voting shares don't have a significant percentage of the company in any event. They might have 1 or 2% or 3%, and you as the founder have the other 95, 96%. So your vote is just going to blow them over in a sense. You get your way in any event, and so to create the class is more expensive than it needs to be, more complex than it needs to be.
So in other words, we could make the classes when we need them, if and when we need them, or whenever the investors want to come in. Is that another way to look at it?
Yeah, you'd build them up as you'd add them as needed, as dictated by the investors.
Oh, you're jumping in. Do we have a question from the panel?
Yeah, I'm just jumping in with a question. So we have a question for the panel. Although the founder's lawyer will provide legal and financial advice when deciding whether to raise funds or evaluate an offer, is there anyone else who may serve as a strategic financial advisor to the founder at this stage? And how might their advice differ from that of the founder's legal counsel?
So if I might jump in. So typically the accountant and the lawyers work hand in hand to assist the founder for their strategic objective. Bar none, the lawyers are someone like Prentice would be the expert in the legal advice, and no accountant should ever express any legal opinion, period. Well, where we kind of shine in our area, if we will, is really the numbers part, and also assisting the founder in kind of translating their story into numbers, if you will. So where us as advisors, me and Joe here, where we could help the founder, the business owner, it's really assisting them in preparing the financial statements in a form that's acceptable for potential investors, and B, assisting them in translating into a forecast, so that in a form of a pitch deck, if you will, so that the investor could look through this 10-page, give or take, to get a better idea of where the business is going, so that when they start thinking about getting investors to buy up certain shares, a certain percentage of the company, they have something on hand, sort of like a teaser as to what they're getting themselves into as well.
Yeah, William's bang on there. Cash flow management is important, and as your business advisor, we're going to be on deck to help you out with that. I guess the other part where we can get involved is where you're thinking about potentially going to like an RTO or something like that to get an exchange listing. Reach out to us for potential RTO or shell candidates that you could use to as a vehicle to get listed. Typically, the partners have a number of client contacts where they've got the right kind of shell for your company, and that can facilitate your IPO process.
Great, thank you. Sorry to interject just now.
No,
Well, that's all good. I just add one more thing, which is, as you're looking for investors and you're participating in events like these and meeting folks, you'll inevitably come across people that are in the industry. As investors, they see deal flow. They haven't done your deal before, but they've certainly dealt with other companies or invested in them, and they just have their finger on the pulse of what's happening in the business community. And those people can be really valuable. And so, what role do they take with you? Some call them mentors, advisors. Maybe they're your investor, but aside from your hired guns being the accountants and lawyers, just having people in the community that are just dealing with it on a day-to-day basis and seeing deal flow can really be helpful in this process of understanding, what might be a good deal and what might not be a good deal. And, I've got a term sheet put in front of me that has all sorts of, bells and whistles on it. Is it a good transaction or is it too expensive? I had one deal that came in, this is several years ago, but it was an investor willing to invest $25,000 in the company, and they wanted preferred shares and shareholders agreements and all sorts of things. And my first comment to the client was, "Don't take the money." And they said, "Why?" And I said, "Because it's going to cost you $25,000 to get the $25,000. So, bad deal." Anyway, anecdote. Anecdote to take home with you. Just make sure it makes sense and use everyone around you to bounce the idea off.
Maybe piggybacking off that, Prentice, you raise a good point about you talked about shareholders agreements or things like that investors might want you to do with the money. Are those things needed before you start fundraising? Can you get those things later on and get them down the road, or what does that look like when you're starting to raise money?
So you have to ask yourself, why do I need it? Why do I need or want a shareholders agreement? And there's typically a few reasons. One is that you want to make sure that the shareholders vote the board that you want, being, you, the founder, and maybe one or two others. But more importantly, we can include provisions in shareholders agreements like drag along provisions, which means that if a majority want to sell, the minority have to follow. Maybe some information rights, and maybe the investors just want some, put some handcuffs on management so that they can't go and spend money, to their heart's content. But in any given case, you want to put some ground rules around how the shareholders are going to behave. And if you do that early, it's a lot easier to sort of impose it on new investors coming in. And at a certain point, when that new investor is big enough, they're going to rewrite your shareholders agreement anyway, and or impose a shareholders agreement, if there isn't one, on the shareholders or a certain group of them. So it sort of depends on what the issues are, but it's more common that we have one in place to deal with share sales or the like, because it's easier to once you have it, to waive it rather than imposing it on someone later on.
And to add to that, another important factor, more so based on my experience in the valuation space, in shareholders agreements are really during a certain transaction event or triggering event, as commonly defined. It's how do you treat certain issues such as minority discounts? Should one apply? And minority discounts in a very 30,000 level foot view, it's really a certain discount applied to a percentage of shares simply because they do not have a controlling position, that being 50% plus one share in a company. And because they don't have that control in the vote to move the business in a direction they want, there's typically a discount applied. So the shareholders agreement could dictate that no minority interest or minority discount would apply to those block of shares, which kind of protects the minority shareholders, as you can see. And other triggering events such as what's the treatment if one shareholder happens to pass away? What happens to the spouse of that shareholder get those shares? And sometimes the spouse might not see eye to eye with the other shareholders. And it's really the shareholders agreement kind of illustrates what happens. Do the other shareholders get to buy the deceased shareholder shares in order to prevent a potential friction amongst the new class of shareholders?
Maybe I'm going to ask a crazy question for the lawyers and the financial advisors on this panel. Do we really need that thing from day one, or is that something we can get months or years down the road when we have a little bit more money?
Personally, I think for the triggering events, it's, and correct me if I'm wrong, but usually I do see them in, I'd say 90% of all shareholders agreements. But that being said, if it's going to be rewritten by if the new investor decides to rewrite the shareholders agreement anyways, I'm sure they have certain terms that they want implemented in there. So I prefer to say that earlier the better, but I don't have a certain concrete advice to say, yes, it has to be earlier.
I'd say that if you're, you're the entrepreneur, the owner, and you've got the large controlling block of the shares, probably don't need one right from day one. But if you've got partners, I'm pretty sure that everybody wants some sort of protection or agreement or an understanding of the ground rules. So, if you're going to go into starting this business with a few other partners or investors, I think everybody's going to want to have the ground rules laid out. And correct me if I'm wrong there, Prentice, but I don't think you need it from day one unless you've got other shareholders that are kind of splitting the business with, and everybody understands here's how we're structuring it. Here's what our rights and obligations are, and then you just move on from there.
Yeah, again, it depends on the circumstances, because I've had several new clients or clients that come and they say, okay, well, it's just two of us and we don't intend to raise money. We might, but we're not sure. But we're just going to go for it. And my comment to them is, okay, well, what happens if you decide to, have a corporate divorce? And if you don't have a shareholders agreement, you're just negotiating from scratch. I like to refer to them as rainy day agreements, because it's really only when things are going sideways that people start flipping it open and kind of going, well, what does the agreement say and what do we need to do? If you're bringing in a few smaller shareholders, and maybe that's even employees, and you've granted options and they're exercising their options, under what circumstances do you want to let them become a shareholder? And again, if they're really small, like 1 or 2%, you have the votes, and you can do this and you can do that. But as soon as you want to sell the company and you want to sell the shares, because there's maybe lifetime capital gains exemptions we want to take care of, so it's a share sale, that 1%er now has a veto, and they can block your sale because you need their signature. Or what typically happens is they just hold you ransom for a bigger check. And so, if you're willing to navigate that without a shareholders agreement, that's fine. But most people don't, and they say, yeah, you're a minority, you get to be dragged along with the majority when they want to sell. And they say, okay, well, if you're going to do that to me, then I want some rights. Okay, what are those? And usually what we give up relatively easily is a preemptive right on future equity issuances. So if we're raising money, we'll say, hey, you're an existing shareholder, you can keep your pro rata percentage, but don't forget, you're also a party to the shareholders agreement. We get to drag you along in an exit. And so, again, whether you put that in place early on or not, sort of depends on the circumstances. And you might say, what, we're going to just kick that down the road because we don't want to spend a few $1,000s on putting a shareholders agreement together. We don't have it. We're going to wait, and that's fine. But it's important that you sort of understand and go through that process of, this is what could be the view of the world, or this is what the world could look like. And in the alternative, it's over here, and you just have to be ready for that. And And so again, it depends on the circumstances. And if you have a whole bunch of people that could act independently, which of course they're entitled to under corporate law, they don't have to vote with you every time, unless the shareholders agreement says so. So it depends on the circumstances. As I said, I call it a rainy day agreement, because if things go sideways, that's when people start looking for them. And the timing varies for when is the right time.
There is a quick follow-up question for that. So given the importance of the core professional team, legal and accounting, how should a founder go about interviewing these potential professional partners and selecting their team?
Well, it's kind of like dating. You want to meet them in person and just get a sense for, how you think the relationship's going to work. I think you come prepared with your business plan and what your goals in the future are, and ask, be prepared with the questions that you want to ask, so that you can evaluate whether the responses are kind of in line with what you are expecting. I think with any professional that you're going to interview, you're just going to get the sense if they know your business or not, if they know kind of like the roadmap for you in the future. So, yeah, it's dating a bit.
Maybe just to quickly unpack that, Joseph. Joe, what do you mean by know your roadmap?
So, for knowing your roadmap, you got to think about, okay, well, if you're just like right at the beginning of your journey here, you're going to have some goals in the future and where you want to get to and what you want to accomplish. You want to partner with somebody that understands what your goals are and can advise you throughout that process, and preferably has experience doing this with similar companies. You're not going to be the first company that any of us have ever seen. We've all got tons of experience helping entrepreneurs build up their business from scratch to the end, whatever that end may be. So when you're getting into that kind of interview with your professional advisor, you're going to get a sense if they know what they're talking about or not. Ask about their experience. Like, well, here's what my situation is. Have you dealt with companies in a similar situation? Do you have any thoughts on what's coming up for me, what I should expect? Are there tax implications that I need to worry about? And the whole conversation on shareholders agreements. I think that, as you gain experience interviewing professional advisors, you will have I call it an instinct, if the relationship's going to work, it's a good fit.
And I think to add to that is any professional advisor, really the best ones aren't afraid to tell back to the investor that their ideas or what they're trying to present might be too aggressive too early. Say a potential business owner says, I'm going to start from $0 to $1 billion in 1 year. I'd say 99% of the time, 99.9 even, it's not going to happen. The best professional advisor will tell you right off to your face that it's way too aggressive or just not realistic enough. Whereas those who kind of act more of a cheerleading role may not have the industry experience, or might not have that experience to lead you to ultimately succeed. Maybe it might take you 10 years to reach that $1 billion target mark. But to just kind of lead you blindly to say, yeah, that 1 year sounds reasonable, that's what might differentiate between two professional advisors.
Yeah, I'd like to, I guess, just Joe's comment about the dating scene. It is just that. I think it's important to, get a few referrals. And, I just got a client recently that was, I think that their SHRED advisor, right, the scientific research and experimental development credit, like the person that was helping them file that for that SHRED credit, had said, oh, go use, this lawyer over here. So the problem that right from the outset was the lawyer over here was a real estate lawyer, not a tech startup lawyer. And so back to our earlier discussion, suddenly, this company came in with 8 classes of shares and all sorts of bells and whistles. And it was there was the company was incorporated, the company exists, the company, like the, you know, there's no issue there, but it's not geared up for an investor friendly tech play. And so, you know, what, you know, that CEO in retrospect should have, oh, great, okay, do you have anybody else? Like, let me go talk to 2 or 3 folks and let's see. And Joe made a really good point. It's that, you know, there's one thing that, you know, once you find your group of tech lawyers, for example, okay, who out of that group, you know, do I trust? And who can I work with? Because you end up, you know, we end up providing advice and you know, clients take it or they don't take it. But, you know, we're giving you the best advice we can. And if you don't trust that advice, then why are you using that person? Like, go find the person that you trust and build that relationship. Because I think for the most part, Will and Joe, I think, would concur, you know, we like working with our clients. We like it when the clients work with us, and it's a collaborative effort.
Yeah, and you know, that's exactly the point. I think what you're looking for is, you know, there's a lot of professional service advisors, but I think what you're looking for in the long term is somebody who's going to be, you know, your advisor and investing in your business as well. You're looking for investment, you're looking to build, and you want somebody that's going to be along with you during that process to help you build. And that trust aspect is super important. You're going to go to your advisor, legal, accounting, or what have you, with the questions about, well, what do you think about this? And well, should I do that? You want somebody who's responsive and who is creating an investment in your firm.
Yeah, you know, we've got this is great feedback. So we've got a question in the panelists on another one. We've got, maybe this one's a little bit particularized, and I'm presuming we're going to go down a it depends route. But the question is, for crowdsourcing startup, what kind of shares or return on investment would you suggest?
Don't crowdfund. I guess crowdfunding is one of these rabbit holes that seems like a really good idea, but there's a lot more to it. Crowdfunding is typically a last resource, or last resort. You have exhausted others that will write a bigger check. It's always easier to answer to one shareholder rather than 50 or 100 or however many crowdfunding brings in. So you know, that's sort of the first caveat about it, is that, you know, be careful what you're taking on there. You know, it's like no other. You know, why would you create a class of shares independent just for the crowdfunders, right? You'd bring them into your existing class. You wouldn't sort of, you know, part of the problem is that, you know, you've got a lot of little voices in crowdfunding that may make up a larger dollar amount, but, you know, who's directing that? Who are you negotiating against? Like, it's just, you know, you would just bring them into your existing common shares, for example, if you were to do that. And the price, you know, again, that's a tough one, because that's typically a negotiation of valuation. With a crowdfunding scenario, there are service providers out there that help you with crowdfunding, and they would sort of help you price it and do all these things. But, you know, without an intermediary, and if you just went out there and crowdfunded, I'd say you're negotiating against your stealth from the outset.
Gents, the other gents in the room, we did have a question. You know, is this, maybe I'll qualify. The question is really about what sort of return on investment would a crowdfunded financing hope to achieve? And maybe the second question I'll ask is that appropriate to even figure out now? Or is that something we can even peg at this point?
In terms of crowdfunding, I think it might be a bit too early to set a certain rate of return or return on investment, if you will. I mean, usually it's when you're presenting a pitch deck and really trying to get the numbers in play, then you'll start throwing certain numbers around. Say in tech, you'll probably throw in 20, 30%, if not more, depending on what type of service or what type of platform you're offering. But if you're simply crowdfunding, I think really presenting the story behind it is a lot more important than putting in real numbers, because for the most part, the ROI, it's assuming it's still a fairly relatively early stage company, it's hard to peg what type of return that the company could offer to its investors aside from something more aloof as a certain percentage, but it might or might not be achievable at this point.
You know, if we can come back to the parts where we had just before these questions. So we've sort of talked about a few advisors and the importance. I mean, it's been a recurring theme. We need good advisors. We need to get good advisors on the financial front, the accounting front, maybe the valuations and forecasting front, on the legal front. When do we get those people involved? I mean, is it when we have money knocking on our door? Is it when we're thinking about raising money? You know, when should we start reaching out and sending those emails?
I think on the legal front, definitely you want to get that find that relationship very early. So you as Prentice was saying, that you have the right setup for your company, and it's going to allow it to grow and cause you minimum headaches as you're in the early stages. For on the accounting side or valuation side, it's going to really depend on like you're going to have your own team. You're going to have your accountant or what have you, right? So you got your bookkeeping taken care of. Or you can always reach out to develop a relationship with an accountant if you want to outsource that. I think like on kind of the higher level there, where you're thinking about raising capital, doing some sort of transaction, you're going to be wanting to talk with your accountant when you've got a bit of a more sense of when what you're going to be doing that and what your plan is, so that we can best assist you. I guess another way to look at it also would be, if you develop that relationship with your accountant, kind of earlier, and then they're doing the booking for you, you can start building that relationship with them and developing that trust. And when you get to a point where you need a little bit more firepower, they can refer you to somebody who's got the expertise and the right background to help you the best. So relationship building, it's you can start it early, but for sure on the legal front, I think you want to get that expert advice sooner rather than later.
Yeah, I'd say that quite often a company will, and again, the valuation, it ends up being a negotiation. So I get a lot of clients that say, okay, well, who should I get to go value my company? And and this is fairly early stage in context, but my concept is, well, you should just sort of declare what your value is. When we were talking about rounds of funding or rounds of financing earlier in the call, when you're bootstrapping, friends and family, those initial, early rounds, as Will said, they're investing in you. And so it's a little bit of, you're giving 10% of the company up. Whatever the valuation number is what you've just raised. You need $100,000 or $250,000 and you're giving up 10%. Well, if it's $100,000, right, you're $1 million company, just by definition. Are you really $1 million company? Probably not, but you got to start somewhere. And then you get into a later round where someone says, okay, well, I want to buy 30% of the company for X dollars, and that would put the valuation at maybe it's $10-15 million. Well, what substantiates that? And I think at a certain point, the investor, if an investor is sort of dealing at that level, they've got a pretty good understanding of how to value a company, right? They can look at your financial statements, they can look at your projections, they'll calculate net present values, they'll do all sorts of things in a variety of ways to come up with why they think it's higher or lower. And odds are, guess what the investor's going to do? They're going to push it lower, so they'll write you the same size check and get more of the companies, right? So the company's always trying to push that valuation up. Do you need a third party advisor for that? Maybe, but it just depends on what the circumstances are and the complexities. And at a certain earlier, certainly at the earlier stages, I just don't see third party evaluators really putting together modeling that goes above and beyond to sort of hard code this value. It is much more of a negotiation because so much of it is forward looking projection and blue sky thinking. And so it just turns into, a little bit of just, as I said, negotiation.
Yeah, I'll agree with Prentice there as well. So for very early stage companies, it's kind of your guess is as good as mine because everything's forward looking. I'd say when an actual evaluator comes into play is when the company is a generating positive revenue and positive what we call EBITDA, or earnings before interest, taxes, depreciation, and amortization. Once you have certain key metrics in play and there's a sign of growth in the business, then it starts to become a you might want to start to entertain the idea of having a valuation or even a pricing analysis. As Prentice has said, say an investor offers you 100,000 for, I don't know, 10% of the company, or $1 million for 10% of the company. Then it's kind of saying, should I, like either way, I think most of the time the investor kind of has that dollar value locked in place as to how much they want to invest in the business. The question then becomes, what percentage are you willing to offer them? It becomes sort of like, if you will, Shark Tank kind of discussion whereby you kind of go back and forth. I'll offer you 30%, or no, I'll offer you 25% instead because 30% is too deep or too heavy. And you kind of go back and forth. So a third-party pricing analysis kind of puts you at a relative level whereby you're confident enough to negotiate with that investor. But only when you're starting to generate positive earnings and showing a strong growth in revenues for that period as well.
Yoki, just a quick check-in on time. Do we have till 3:30 or 3:45?
You have till 3:45.
Okay, perfect. So a little bit different in Huva. You know, okay, so I guess just to summarize, Jens, is it really that simple that investors might just want to focus on the dollar and then the percent they get for that dollar? Or am I oversimplifying it in my mind right now?
I think it depends on the investor, but I think most investors have a certain dollar they're willing to invest in a company if they truly believe that business idea or the model. And now it's really negotiating. I'm willing to invest, say, 100,000 into this company, but now it really depends based on my risk appetite, as well as other factors, say your return on investment. Then it's really what percentage or what chunk and how much control or voting power, if you will, do I get? Like, do I get to be voting a director or board of director to be at least one seat out of the three? Just to really, how much control do I have over the company as well? So then you kind of go into the more finesse points as to how much influence that investor has to, and it's not necessarily a bad thing because these investors bring in a wealth of experience that could bring the company to the next level. And usually when business owners are trying to raise financing, the most ideal investors are those who has experience and are able to grow the company, because then it helps all parties, both the investor, since they get a better ROI, and the business owner themselves, since now they're getting to a next level company as well.
These investors with that experience, is that what we mean by smart money?
Sorry, could you say that again, Ryan?
When we say investors with experience that can help out and lend a hand, we've heard this come up a few times now. Is that what we mean by smart money?
I'm sorry, I actually haven't heard smart money before.
Yeah, I can take that one. That's absolutely correct. So you know, you're going to go out and you're going to raise some capital. You got somebody who's willing to partner with you, who believes in your company or you, and you know, unless they're looking to have like a really direct interaction or oversight of the company. You know, typically you got your angel investor or whoever who's going to put some money in, but they have a lot of experience. So again, you're partnering with somebody that's not new to the game, and they can help guide you too. They're going to be able to chime in on questions that you might have as you're continuing to grow your company. And so having that friend to lean on is very helpful. That's smart money.
Thanks, Joan William. Prentice, I can jump in here before we go to the next topic.
I don't need to. It's all going well.
Perfect. Guys, one of the things I think is worth mentioning or paying some lip service to, just partly given the fact that it's built in the title of this panel, we've talked a little bit about the different rounds between seed and series as they get bigger. We've talked about advisors. We talked about getting people involved. There's a lot of information. can we maybe dial it in, or as we look to wrap the conversation up in the next little bit here, about what some of the best practices might be from each of our perspectives, or maybe, let's put it simply, what are maybe 3 or 4 tips that you would have for best practices in raising money from each of our unique perspectives? Because I think everyone's going to come at this from different angles.
Yeah, I mean, from the whole accounting side, it's always get your numbers in check. Ideally, don't put personal expenses through your business, because those are always a nightmare, especially if you're putting grocery bills into your business. That's not a good practice, period. It becomes a nightmare, especially if you're trying to raise money. Joe?
I'd say best practice, start a relationship early with your accountant, and get that, build up that relationship, because it's going to be hopefully long term. Get somebody that you're comfortable with and can help answer your questions or guide you through the whatever life may bring you in your entrepreneurial dream. You're just going to know the right person. You're just going to get a feeling for that, and then you have a good working relationship. And life's going to bring up challenges, and that advisor is somebody that you can talk to and help guide you through or navigate those challenges that arise. And dollars to donuts, if they don't know the answer, they're gonna know somebody that they can refer you to that they trust. And so the building of that network of professional experience is quite important.
Yeah, good comments, Joe. I think that, I would say start early, and we talked about advisors, but again, if those are not necessarily accounting or lawyer folk, but just people that you can bounce ideas off and sort of take the temperature of what something might, what a financing might look like. Again, a little bit like the dating scene. The first term sheet that comes across your desk might not be the best. Or the first proposal for an investment might not be the best. It might be too expensive, not necessarily because of an interest rate, but because of a board seat or some other string that they attach. Knowing what's market, it's easy for us to get sort of, as entrepreneurs, to get sort of, wrapped in our bubble and just be focused on our own business, which, that's part of it. But having someone that's outside of our little business bubble, that's seeing other deals, what's market, what's fair, what's reasonable, you need that sounding board. So start early and have a couple folks on the other end of the phone that you can bounce ideas off.
That's great. And I think hopefully this is helpful for the audience as we go through this. I mean, we really try to summarize information along the way. We have a few more things to cover too, but if anyone has any questions, this is just a good check-in for about the last 10 or 15 minutes here. Pop those questions into Whova or raise your hand, and we'll come back to you and see if we can answer some specifics along the way. We've given lots of general. Let's see if we can help provide more information that might be helpful to think about. That said, maybe it's worth gauging the audience temperature here in some of these earlier polls. It seems like folks might be on the end of some of these first raises, or might be more unfamiliar with the territory of financings. Would we be able to go through a really high level of what does the first financing look like, whether it's a seed round? Maybe a good question is just, what does the first seed round financing roughly look like from an accounting and legal standpoint? What are the things that you sort of have ready? What does it roughly look like? And then what does it look like at the end of that? Where do you go from there?
So I could speak on terms of the financing, kind of in the numbers area. So I've done a few in which it was at that seed round. So the business owner has the idea, the kind of business concept in place, pre-revenue, but ultimately they want to raise funds and they have potentially interested investors to invest in them. So now the question is, the investor is just asking, so send me a pitch deck, we'll talk to people. And it wasn't just in Canada, it was a lot in, Silicon Valley, ultimately. So a lot of interested investors there, and they like the idea. Now they just wanted to see some numbers to kind of support, as you will, that idea, to kind of show them that they're willing to take that risk. So then we kind of went on to really taking a deep dive into what the inputs are and the outputs in really making the financial model to put it into the pitch deck and kind of arbitrarily set based on what the forecast numbers are, what the rate of return on investment is for those funds.
Yeah, I think that, what it looks like. I think one of the important things at any time that you're going into a round of investment is, what are you going to use the money for? And I think that, you've got to, as an entrepreneur, you've got to be, again, depends on the round, but regardless of which round you're investing in, investors want to know that the entrepreneur is in effect all in. They've written a check themselves. They're committed for several years to come. If it's an A round or B round, maybe there's a sophisticated or more detailed business plan that outlines the next 5 years. And lo and behold, the CEO has got to be a part of that, or the founder's got to be a part of that, right? So I think it really depends on sort of the plan. Raising only so much money as you need. Every once in a while, people seek higher valuations or too much money for really what they need to do, and it sort of skews cap tables and other things out of order. Lean is good because you end up being efficient and stretching dollars, and investors should be looking for that. So entrepreneurs, again, you should be looking for that. You're not looking for big fat salaries. You're looking for building equity in your company and looking at an exit event that is your ultimate payday.
Yeah, you've got to have some skin in the game, so that's exactly on point. Cash flow management is important, it's a long journey, definitely having some firepower help on your side is going to help you navigate that process.
And of course, setting certain milestones in place while writing out as to a certain specific date, what would be achieved by that date. And of course, the executive management team, be it your CEO and really the business owner themselves, could set certain milestone triggering or hurdles whereby they get extra stock options or whatnot included in there so that they don't necessarily take a dollar amount in terms of salaries, but certain incentives that kind of pushes the executive team or your management team to meet those target goals. It might be lofty, but if they achieve it, they get a certain payout, if you will, in terms of shares or whatnot. So that would definitely incentivize the management team to go and actually overperform to get the company to as best of a place as it could be.
Sorry, just looking to see if we have any more questions in the panel or in the Kuva app here. We're not seeing any new ones jumping up, so maybe we can sort of look to wrap up our thoughts, I think, pretty shortly here. One thing that's maybe just a final thought here is, before we start scooping and wrapping up, Prentice raised a question just about not over raising money or not getting too large of checks too early on. Maybe more on the accounting side. Jens, do you have any thoughts or issues with that? If you seek to raise too much too early, that seems like a good thing.
Yeah, well, on the accounting side, I'd like to see money coming in the door. So yeah, not an issue there. I think what you want to be concerned about is share dilution and value for money. Prentice was highlighting those issues, which are, they're going to give you this money, but what's the cost? I know the early stages, you need cash. Yeah, you need to keep your working capital up. You need to run your operation. But you realize that every time that you do a round of financing, you're giving up something that you value in your building. So pay attention to okay, well, how much am I giving up? Do I need this amount? Because it's not, you're not looking for a 1 year or 2 year payday and then you're out. I mean, this is a long-term proposal, and how you manage your shareholders going forward and how much you give up in the business as you raising financing is important. And it's also going to be important. Let's call it 5 years down the road, you're executing your business plan, you're raising capital, and you're looking to go public. Well, if you've got a bunch of share dilution and people that you can't work with as part of the shareholders, they're going to cause problems for you when you're doing a prospectus or an RTO or something like that. So get to know your shareholders and that you're not giving too much up as you go along.
Yeah, I agree. Like, there's never a such thing as too much money, but granted, do be careful as to what you're trading in for that extra bulk of cash. And secondly, I'd say run it as lean as possible. So just because there's extra capital in the door, it doesn't necessarily mean the business owner should go and splurge on something that they don't necessarily need, especially at an early stage. So no new yacht or no new Ferrari yet.
That's great. You know, I think maybe in these final minutes here, because it looks like we're having a few folks drop off in the audience, and I think it's probably best just to get everyone's attention with some pithy summaries here. Some of the recurring trends we've heard along the way, and gents, jump in if we have missed anything. It really sounds like build those relationships early, try to get the right people on the bus, whether it's accountants, yes, formal advisors, get your professional advisors, get the right team. You know, it's trying to get the right people involved, get the relationships going, have lots of early conversations, and ask lots of questions. And anything else we're missing along the way?
I think that's a pretty.
Yeah.
Oh, go ahead.
I'd say, yeah, that's pretty much a good summary. Thank you, Ryan. In essence, just talk to people. I mean, it never hurts to chat. And quite frankly, I can't speak for others, but as an advisor, I don't have your credit card information right off the bat. So it never hurts to give me a call and just poke questions.
Yes. Yeah, that's exactly on point. So you know, you're gonna be interviewing your advisors, and you know, the first call is always free, right? I mean, we're trying to figure out if you know, how we can help you, and you can't do that without having a conversation. So don't hesitate to call people. Talk to your friends about who they've worked with, that you know, they've developed a good relationship with. You know, referrals are great, and yeah, start early, develop that that relationship. Because you know, as time goes on, you're going to want to be leaning on somebody that you trust, and that's the whole point of our service provision, is to develop that trusted advisor status with you. We're invested in seeing you succeed.
Yeah, I couldn't agree more, Joe. That's good points, and Will too. Yeah, it's more of the same. Lots of conversations, and it sort of forces us to have more conversations than we maybe want to have, but it's a necessary evil to be successful in this little game here of the startup world.
Well, thanks everyone. Thanks everyone for that. I think this is helpful for me as I'm gathering this info for myself and writing it down beside me. May have also come across it a few times, but this is really great, everyone. Should it be, if anyone needs to get in touch with anyone for particular questions, is it best to reach out by email, LinkedIn, throughout the panel, or what's the best way to get in touch with folks?